Let's settle this once and for all. If I hear one more financial guru tell me that renting is throwing money away, I think I'm going to lose my mind. And on the flip side, if I hear another person say that buying a home is the best investment you'll ever make without looking at a single amortization table, I'm going to lose it too. The truth? Both of them are wrong. Or more accurately, both of them are only giving you half the story.
We've been brainwashed by the American dream to believe that owning a home is the ultimate sign of making it. We're told that a mortgage is just a forced savings account and that a landlord is just a vampire sucking away your net worth. But we are living in 2026. The math has changed. Interest rates, property taxes, maintenance costs, and the opportunity cost of your down payment have created a reality where, in many cases, renting is actually the smarter financial move. Today, we're going to strip away the emotion. We're going to ignore what your parents told you, ignore what your real estate agent is pushing, and look at the cold, hard numbers. By the end of this video, you'll know exactly which path is cheaper for your specific life. Let's start with the renting is throwing money away myth. This is the most common argument in the book. The idea is that when you pay rent, that money is gone forever. But when you pay a mortgage, you're building equity.
Here is what they don't tell you. A mortgage is also full of thrown-away money. In the first 10 years of a 30-year mortgage, the vast majority of your monthly payment isn't going to your house. It's going to the bank in the form of interest. Then you have property taxes. Gone. Homeowner's insurance? Gone. Private mortgage insurance, or PMI? Gone. Maintenance? Gone. These are what we call unrecoverable costs. When you rent, your rent is the maximum you will pay for housing that month. When you own, your mortgage is the minimum you will pay. If the water heater blows up on a Sunday night, the renter calls the landlord and goes back to sleep. The homeowner? They're looking at a $2,000 bill and a stressful Monday morning.
Now, let's talk about the hidden tax of homeownership: maintenance. The rule of thumb is that you should set aside 1 to 2% of your home's value every year for repairs. If you have a $500,000 house, that's $5,000 to $10,000 a year. That's nearly $800 a month just to keep the house from falling apart. If you're comparing a $2,500 rent payment to a $2,500 mortgage payment, you're not comparing apples to apples. You're comparing an all-inclusive stay to a fixer-upper subscription. But wait, I'm not just here to bash buying. Let's look at why buying can be the winner. The biggest advantage of buying isn't actually the investment return, it's the fixed cost factor. In a world where inflation is eating everything, a 30-year fixed-rate mortgage is a beautiful thing. Your principal and interest stay the same for 3 decades. Meanwhile, your landlord can hike your rent 5 or 10% every single year. In 15 years, that expensive mortgage might look like a total bargain compared to the market rent in your city. Buying is essentially a hedge against inflation. You are locking in your housing cost at today's dollars. Then there's the leverage. This is the secret sauce of real estate. If you put 10% down on a $500,000 house and the house value goes up by 5%, you didn't just make 5% on your money. You made 5% on the house's value, which is $25,000. Since you only put $50,000 down, that's a 50% return on your investment. You can't get that kind of leverage in the stock market without a massive amount of risk. But, and this is a huge but, leverage works both ways. If the market dips 5%, you just lost half your down payment in paper value. Now, let's talk about the opportunity cost. This is the part that most people completely ignore. Let's say you have $100,000 for a down payment. If you buy the house, that $100,000 is now dead money sitting in your walls. It's not paying you dividends. It's not growing in the S&P 500. If you took that same $100,000, rented a modest apartment, and invested that money into a low-cost index fund, historically speaking, you would likely end up with more money after 30 years than the person who bought the house. Why? Because the stock market has historically outperformed the average appreciation of residential real estate once you factor in the costs of selling, commissions, and those endless trips to Home Depot. So how do you actually decide?
You use the price-to-rent ratio. This is a simple bit of math that will change how you look at houses. You take the purchase price of the home and divide it by the annual rent of a similar home. If the number is under 15, buying is usually a steal. If it's between 15 and 20, it's a toss-up. If it's over 21, you are almost certainly better off renting and investing the difference. In cities like New York, San Francisco, or Austin, these ratios are often in the 30s. In those markets, buying isn't a financial decision, it's an emotional one. And that's okay, as long as you know it's an emotional one.
We also have to talk about lifestyle flexibility. The middle class is being squeezed right now, and one of the biggest dangers is being house poor. This is when so much of your income goes to your mortgage that you can't afford to take a new job in a different city. You can't afford to start a business, and you can't afford a flat tire. In your 20s and 30s, your greatest asset isn't a house, it's your mobility. It's the ability to say yes to a 20% raise in a different state. If you own a house, moving is a nightmare. You have to pay 6% in realtor commissions, closing costs, and moving fees. If you haven't lived in that house for at least 5 to 7 years, you will likely lose money just on the transaction costs alone.
So, here is the human verdict. Buying a house is a great move if 1. You plan to stay put for at least a decade. 2. The monthly total cost, including taxes and maintenance, is comparable to rent. And 3. You actually want to be a homeowner. Do you want to spend your Saturdays mowing the lawn and fixing toilets? Some people love it. It's their hobby. If that's you, great. Renting is the winning move if 1. You value your mobility. 2. You are disciplined enough to actually invest the money you save by not having a mortgage. If you rent and just spend the extra money on vacations and clothes, you're going to end up poor, period. And 3. You live in a market where home prices have completely detached from reality. Don't let society shame you into a 30-year debt sentence, just because that's what adults do. Being an adult is about understanding your own balance sheet. It's about knowing that a house is a service. It provides shelter. Sometimes it's a good investment, but it is always an expense. Before you sign that 3,000-page mortgage document, run the numbers. Calculate the unrecoverable costs. Look at the price-to-rent ratio in your zip code. And most importantly, ask yourself, am I buying this because it makes sense? Or because I'm afraid of what people will think if I'm still renting at 40? The middle class is changing. The old rules don't apply. In 2026, the richest person in the room might be the one with the lease agreement and a massive brokerage account, not the one with the white picket fence and a massive debt to the bank. Thanks for watching. If this helped you clear the fog, hit that subscribe button. I want to hear from you in the comments. Are you team rent or team buy right now? Let's get the debate going. I'll see you in the next one.